We're going to start with a slate of all-time highs on Wall Street.
Today's market breaking new records.
The S&P 500 has hit 4 record highs this month.
The stock market just hit record highs again. Everybody's talking about it, but most people are just standing on the sidelines watching other people build wealth instead of doing it themselves. I started investing when I was 15 during the 2020 COVID pandemic shutdown with just $100. 5 years later, at just 20 years old, that small start has then since grew to over $30,000. So if you're wondering how to begin, whether you have $10 or $10,000, this video will walk you through some of the basics on how to start investing and building your wealth the smart way. I'm Sebi Serrano, your young advisor, and today we'll be going over Investing 101 for beginners of all budgets, ages, and experiences. Let's talk about it. And a quick disclaimer, this is not financial advice. Invest at your own risk. Before you invest a single dollar, you need to know what type of investor you are. Let's find out together. Let me ask you these 3 questions. Question 1. Do you like the idea of researching companies, analyzing financial statements, and trying to beat the market? You're a stock picker. Or maybe you prefer investing your money, forgetting about it, and letting it grow without the constant need of attention. You're an ETF investor. Or maybe you'd rather have consistent, predictable income, even if your initial investment doesn't grow too much in value. You're a bond investor. Most successful portfolios contain a mix of all 3 types of investments, and the balance depends on your goals, risk tolerance, and time horizon. That's just something to keep in mind. But now it's time to invest. Let's be honest, most people don't have the time or the interest to analyze financial statements or listen to earnings calls. And while bonds are reliable, they usually don't offer too much growth, especially for younger or adventurous investors looking to build wealth over time. That's where ETFs or exchange traded funds come into play. An ETF is basically a pre-built portfolio of stocks. Financial analysts pick dozens, sometimes hundreds of stocks to put in a portfolio, and you could buy a small slice of that portfolio for a single price. So instead of paying hundreds of dollars for a share of Tesla or Apple, you could buy an ETF that includes both for sometimes a fraction of the cost. ETFs are a simple, low-maintenance way to start investing. They give you broad diversification, reduces risk, and eliminates the pressure of trying to find the perfect stock. You can simply own small pieces of many companies at once, and in many cases they outperform people trying to time the market. ETFs generally fall within 2 categories, passive and active, and understanding the difference is key. Starting with passively managed ETFs, these are by far the most popular investment. They are designed to track an index like the S&P 500, which includes 500 of the largest and most influential companies in the US. Think Apple, Tesla, Microsoft, and more. They're passive in the sense that there isn't much movement within the holdings of the portfolio or ETF. It's almost as a set it and forget it type of investment. The 3 most popular S&P 500 index funds are VU, SPY, and IVV. Each one simply mirrors the performance of the S&P 500. No guessing, no concentrating. And these 500 companies represent 80% of the total stock market's value. So by owning one ETF that tracks this index, you're essentially owning a small slice of the US economy. And historically, the S&P 500 has averaged 7% annual return after inflation, enough to double your money roughly every 10 years. And that 7% average also includes large downturns in the market such as the Great Depression or the 2008 financial crisis. And despite all of those, the market keeps moving higher every time. So considering that the market lost nearly half of its value multiple times, 7% is a good return. And there are also some years where the market grows a lot more than 7%. For example, if you were to invest in the lowest point of the COVID pandemic shutdown in March 2020, you would have doubled your money the very next year in November 2021, just by investing in the S&P 500. So yes, 7% may sound modest, but it can be very powerful over time. If you're comfortable with trusting the process and investing in the general market, a passively managed index fund such as VU, QQQ, or SPY should be on your watch list. Now let's move on to actively managed ETFs. Active ETFs, on the other hand, are run by professional managers who try to outperform the market. These financial analysts spend countless hours going through financial reports, analyzing companies' growth, and determining whether or not to include these companies in their ETFs. They only choose companies they believe will grow faster than the index, or the S&P 500 for example. It may seem like a no-brainer to invest in a professionally hand-picked investment that is created to outperform the market. It's free money, right? Even when they outperform for a few years, higher management fees often eat away at the profits. These fees, called expense ratios, often range from 0.5% all the way to 1.5%, compared to as little as 0.03% on passively managed funds. But here's the reality. Most of them don't win in the long run. These fees are taken out of the return behind the scenes and slowly eat your profits, especially over the long run. You can see the difference between investing in a passively managed ETF versus an actively managed ETF, which has a big difference in fees and how that affects your general profit over the span of a couple of decades. For instance, I personally own an actively managed fund that focuses on tech and chip producing companies called FSPTX. It has done very well over the short term, up 80% in the past 2 years. But over the past decade, it has lagged behind the broader NASDAQ index by over 100%. Just something to keep in mind. So here's the key takeaway. Match the market. Don't chase it. Keep your costs low, invest consistently, and let time do the heavy lifting. And once you know what you want to invest in, getting started is surprisingly simple. Step 1. Open a brokerage account. Platforms like Fidelity, Charles Schwab, Wells Fargo, E-Trade are all great options. Upon opening your brokerage account, you can then link your bank account, transfer some money, and begin investing. And remember, you don't need thousands of dollars to begin. Even $10 or $20 is enough to invest. Step 3. Choose an ETF. If you want to track the market, you could take a look at VU, SPY, QQQ, and other ETFs that are made to track indexes. And once you find those investments, all you need to do is buy and hold. That's it. Think of this as planting a tree. It won't go overnight, but 10 years from now, you'll be glad you started today. And before we wrap up, here are a few mistakes I see all the time and how to avoid them. Number 1, trying to time the market. Even the professionals get it wrong. Instead of waiting for the perfect moment, just start and stay consistent. No one can predict the future, so you might as well just start now. Number 2, ignoring dividends. It may seem enticing to keep the cash that you've got from your investments, but putting it back in the stock market will reward you over time. When you reinvest your dividends, your earnings from your investments can then earn as well. That's compound growth at work, and that's why you see over time your portfolio account grow with an exponential graph. And now number 3, selling too soon. Market dips are normal. Every crash in history has eventually recovered. Long-term investors who stay focused and stay invested have always come out ahead. Some of the biggest returns in history happen immediately after a massive downfall in the market. Think of crashes or corrections as discounts. Just stay invested, put more money when you see a discount, and you'll enjoy the benefits too. Investing isn't about timing the market, it's about time in the market. So to recap, stick with low-cost diversified ETFs. Focus on consistency, not chasing trends. And above all, give your investments time. And with all of that being said, thank you for letting me be your young advisor today. Let's all get rich 2025, and investing can help you get there. Hope you guys all have a great day. And if there's any questions, please feel free to reach out. I'm always available for a conversation. Take care.